I run a company called JWH Investment Partners. We are a single family office, not a multifamily office. We do not manage outside money, just in-house capital. We do, however, publish research. I spent my 33 years on Wall Street, most recently working at the Leuthold Group. And within that capacity, I was managing director of global investment strategy. And also prior to that, I was a co-lead portfolio manager on the Leuthold Management, Leuthold Strategies global macro hedge fund, along with Steve Leuthold, who sadly passed away last month at the ripe old age of 85. My experience really extends back to the sell side, where I grew up on the trading desks at Merrill Lynch, Smith Barney, Citigroup, and later Oppenheimer for a couple of years. I worked with some of the most venerable strategists known to Wall Street history, including Bob Farrell for about 7 years, also with Alan Shaw and Luis Yamada's team at Citigroup for about 5 years, and then later with Carter Worth at Oppenheimer before he left and went on his own. Then I went to the Leuthold Group. And so since leaving the Leuthold Group, I started this shop on my own, which essentially was just to run my own money. But eventually I got so many inquiries from friends and former colleagues and former clients, asking what I thought about the market, that I started publishing research. And we now offer this research under the moniker Alpha Insights. It's a subscription service. You can find it on our website, jwhinvestmentpartners.com. We've actually also taken this to a new level. A couple of years ago, we started a newsletter on what was Review at Twitter, and that got shut down last year, and we moved to Substack. And since we went to Substack, it just blew up. I mean, literally off the charts. We are one of the hottest newsletters on Substack right now, with something like 900 paid subscribers. So I'm hoping, Marty tells me there's 500 people at this conference. I'd like 20% of you to sign up for our newsletter. Then we'll be at 1,000, and I can get that little check mark to the right of my name. That'll turn into a bright orange circle with a white check mark. That's the status symbol now. You got to have goals, right? That being said, you can find this at hugeinsights.substack.com. I would like to kick off my presentation with this quote from Ernest Hemingway's "The Sun Also Rises." It's kind of a famous quote. It's where Bill asks Mike, "How did you go bankrupt?" And Mike responds, "2 ways, gradually, then suddenly." I think that sums up exactly what's been happening in the US banking system, but not just the banking system, the non-banking system. And so this presentation is not going to be about the banking crisis. If you want to read about the banking crisis, we wrote an exhaustive expose on it in our last newsletter, so sign up and read that. But we're going to talk today about the impending non-banking crisis. And it really begins with the fact that, back on November 10th, 2022, the Federal Reserve's Financial Stability Board released a study finding that liquidity within the shadow banking sector, this is the non-bank financial intermediaries, or NBFIs for those who are unindoctrinated, is highly constrained, really due to interest rate volatility and economic uncertainty right now. And the FSB now estimates the size of the shadow banking industry at year-end 2022 to be about 240 trillion with a T. That's 10 times the total assets of all US commercial banks. And, there's been several articles in the Journal, the Washington Post, on Bloomberg discussing the emerging worry about the shadow banks. And the issue really is the fact that these NBFIs are unregulated. They can carry much higher levels of financial leverage than traditional banks. And they are subject to the exact same risks that banks are: market risk, interest rate risk, of course, credit risk, and liquidity risk. So I put a link to this paper on this presentation, which Marty will pass along to you, I'm sure. And what the chart's really showing is how those assets are distributed. And I think it's worth your time to really take a look at it. So since I have a short period of time to get through this in 20 slides, I'm going to jump to the next one quick here and talk about one of the issues driving this. Core inflation remains sticky. Monetary policymakers have historically used or monitored a variety of underlying inflation gauges in order to put context around longer-term trends in inflation. And what the Atlanta Fed does is they've created an inflation dashboard. It's a tool that provides information about all of these different measures. There's 9 of them in total. I think 7 of the banks actually have produced these models. A couple banks are not represented there, but the users get a pretty broad characterization of retail price pressures from this dashboard by simply monitoring the movements of, or better than monitoring the movements of core PCE alone. And so the message that the dashboard is giving us today is the fact that now we're now approximately 400 basis points above the Fed's target on average across these measures. But I've circled 6 of these measures, 6 out of 9, that's 2/3. 2/3 of these measures are printing significantly higher year-over-year growth rates. So everybody's looking at the core PCE saying, hey, the core PCE is going down. It's well down from a year ago, well down from its highs. But actually, if we looked at the Cleveland Fed's trimmed mean the Cleveland Fed's median CPI, that actually is just down 0.1% this past reading, the March reading. That hit a new all-time record high last month. That was also true of the San Francisco's cyclical core PCE, hit an all-time record high last month. So, inflation is far from dead at this point. We've been experiencing the most severe rate cycle in 4 decades, okay? Monetary policy has shifted from a 13-year period of aggressive accommodation to one that's now highly restrictive. And so far, the Fed's hiked the funds rate 9 times over the past 12 months, a total of 475 basis points. And they are very likely, to the tune of about 80% probability, to raise another 25 basis points now at the May 3rd FOMC meeting. And that will bring things up to 5.25%. But there are actually several Fed officials, voting members, and very well-regarded business leaders with informed opinions that have espoused the need that we may have to take the terminal rate much closer to 6% than 5% before we're able to kill inflation. And so the idea that the Fed is going to pause immediately and start cutting rates this year, I think, is completely baffling under the circumstances at hand. Yeah, we had a bank crisis, and that was something, but it didn't solve the inflation problem, certainly not yet. So let's take a look at where we think the problems really lie here. Liquidity has been being drained from the system for some time now. Real M2 money stock in the US has declined by 7.9% year over year through month-end February. That's the largest year-over-year decline on record, going all the way back to the inception of the data in 1959. But what's more important in our view is that this decline follows another heretofore unprecedented extreme that occurred on the upside when this series actually grew by 24.7% year over year during the pandemic shutdown. So, logically, one could deduce that a move in one direction might be followed by a move in the opposite direction that overshoots the prior extreme by a similar proportion to the downside. If that were to happen, that real M2 money stock year-over-year growth rate could become a negative teenager, something that we've got our eyes closely on. This is the third and final issue that I think is really going to be pertinent here, and that is that bank lending signals a recession ahead. It's been widely discussed that there's an impending credit crunch, but we think it's already arrived and appears to be in full swing. According to data provided by Bianco Research, loan volumes declined by about 20% during the month of March, most of which occurred in the last 2 weeks following the banking collapse at Silicon Valley and Signature Bank in New York. And, they were 2 of 3 pretty significant regional banks. The other is Silvergate Bank, which is primarily a lender to crypto. But this led to a sudden withdrawal of about $105 billion from bank deposits. And as money seeks higher yields, bankers are now attempting to stem the tide, offering higher yields on jumbo CDs, but it may already be too late. The bank run's over, but the bank walk continues. In fact, Apple just announced today a 4.25% savings account. And there's people out there that might just want to diversify away from banks and put their savings with Apple, a company that they trust, a company that they carry around in their pocket everywhere they go. So, the point is, while the bank run really did create this situation where there's just a dearth of deposit funding for banks, which is leading bankers to curtail their lending dramatically. And money is seeking yields at higher rates at 5% in the Treasury market, where safety, liquidity are paramount. And that may be what's most important. So, I think that this 20% decline that we saw in March in lending is likely to expand into the months ahead. And we think that this tightening of lending standards by bankers and rising borrowing costs, credit card rates are now exceeding 30% on an APR basis. We think that this is going to have a big effect on loan demand as well. The LEI index also signals a recession ahead. Now, the Conference Board's top 10 leading economic index, this is reported with about a 30-day lag. So this is the rate that we saw back in February. And what we saw is that the rate of decline actually leveled off. That was before these bank failures. We think that we're going to see a sharp decline when it's reported in March. But the LEI has had a 100% hit rate when it comes to anticipating recessions. The trigger actually occurs when the index turns negative for at least 2 consecutive months. And this last occurred on August 22nd. And usually when we break 4% to the downside on a negative basis, that's where it's a sure thing. The torpedoes are in the water at that point. And based upon data going all the way back to 1970, the average lead time to this is about 7.5 months. So just using history as our guide, if past is prologue, then we should expect the US economy to enter recession by the second quarter. So we're right in it right now. Also, the yield curve has been signaling a recession ahead for some time. The spread between the 3-month and 10-year Treasury has further inverted to about 152 basis points from about 96 basis points a month ago. But the inversion between the 10-year and the 2-year has actually begun to steepen. It steepened from about 89 basis points at month's end, which was the worst in 40 years, to just around 58 basis points or 56 basis points at month end March. Now, the yield curve inversion has preceded each of the past 5 recessions by about 10 to 33 months. That's a very varied period, right? These variable lags that people talk about. But, that's just the shot across the bow. What's actually the key here is, again, when the yield curve begins to re-steepen. And like I said a minute ago, that's when the torpedoes are in the water at this point. And so we've reached that point. So with that being said, past recessions have resulted in significant earnings drawdowns. Historically, every economic recession since 1957 has been accompanied by an earnings recession. And according to research published by D.A. Davidson, looking back at the past 10 recessions, the average EPS decline during such periods is about 29.5%. And if we exclude the 2 worst instances, the tech wreck and the great financial crisis, they're down on average about 18.7%. Now, IBIS consensus estimates for the S&P right now, S&P operating earnings for 2023 and 2024 are approximately 217 and 244 respectively. Now, what's important here is that at the beginning of the year, estimates for 2023 were $230. That's just a little more than 3 months ago. They've come down from 230 to 217 in just 3 months, okay? We think that 244 number is ridiculous, okay? The 2024 S&P operating earnings are likely to be down if we go into recession in the back half of this year, which we believe we will. And if they were to decline by just half the average, okay, say 15%, that would bring 2024 earnings estimates down to 187. So again, if we're shifting the odds in favor of a recession late 2023, and we think they are, then valuations are going to begin to matter very soon. And we'll get into that in a couple slides. But to begin, I want to just talk about the S&P earnings collapse that we see occurring on the horizon. Our top-down economic analysis points squarely to the high probability of a recession in 2023, the re-steepening of the 210 yield curve, the LEI index model, and the collapse of bank lending all point to this idea that we've maybe reached the point of no return at this point. And so assuming that the S&P operating earnings peaked in 2022 at 219, that's the number that's out there, then 18.7% decline would suggest that S&P operating earnings would be 178. A 29.5% decline in earnings estimates would take them down to 155. Now, while we think either of these levels are real possibilities, especially given the current circumstances facing the banking industry, not to mention the NBFIs, as such, we're introducing our 2024 S&P operating earnings estimate at 187. That is 30% below the street, and it implies a 15% decline in earnings off the peak last year. Our estimates basically, seems crazy to some. In fact, people told us that, putting an out of consensus number like this out there in the public domain is too risky. People will dismiss it as basically hyperbole, right? We think that if our 2024 estimate misses the mark, it will most likely be because it's still way too high. If our estimates prove to be correct, then the S&P 500 is now trading at a PE of approximately 22 times out-year estimates, not 17 times like everybody believes it to be. That means that the market has to compress by 5 multiple turns just to be at break even with the multiple that people believe that we're currently at. We think that's going to be very difficult for investors. High valuations cap upside potential. Right now, the total US market cap to GDP is at 156.4%. That's way below the all-time record extreme of 210%, which was achieved last year, but it's still well above the prior secular peak of 143%, which occurred in March of 2000. In addition, the Shiller cyclically adjusted PE ratio, the CAPE ratio, better known, closed the month of March at 29.4 times. It's currently a little higher, over 30 times right now, but the cyclical high was actually 38.6. The historical average is 17.3. So just to put it in perspective there, the S&P's dividend yield is currently about 1.63%. That continues to plumb its historical lows, while the price to sales ratio is a very bloated 2.4 times. That's down from the all-time record high of 3, which is achieved last year, but it's still way above the March 2000 extreme of 2.1. And finally, price to book values over 4.1 times now. The peak was in 2000 at 5 times, but we're way above the historical trough, which was 209.
Somebody log on here.
Well, the 2009 price to book trough was 1.7 times. So, we're more than double that level. So to say the least, it does not appear that the market is pricing in an imminent recession at this point. Market breadth is extremely narrow. Since the February 2nd high, and we may actually exceed that high today, we'll see. And this is the S&P 500 high. A rather pronounced bifurcation can be observed in the broad cross, across the board in a number of key market indexes. Perhaps most noteworthy is the shift away from small cap sectors and small capitalization issues, as well as value segments of the market, into super cap growth. And the mega caps, if you will, the FANGs. Indeed, only the New York FANG index, as well as the NASDAQ 100 index and the S&P 100 are positive since the February 2nd high. Banks have lagged severely. They're down 28%. SMID caps are down on average 10%. And the equal weight NASDAQ 100 is actually negative for that period from February 2nd to yesterday's close. So for those that are looking at a bull market, we do not see it. We think there's a bull market in 7 stocks right now: Apple, Microsoft, Google, Amazon, NVIDIA, Tesla, and Meta. Those stocks now trade at extreme valuations that exceed the valuations they reached at the peak of the market in January of 2022. So very, very narrow market, very, very high valuations. We'd also point to the fact that we think investor sentiment is now complacent again. There's been a relatively stable relationship over the past year between the S&P 500 and the VIX. And when the VIX has reached a level that exceeds 34%, it is very nearly marked each tradable low in the S&P 500. And when the VIX has reached a level below 20%, actually below 19% is more specific, then it reverses above its 21-day moving average. It's actually coincided very closely with each of the past 4 major highs in the S&P 500. Well, the VIX posted its low for the year on a weekly closing basis on April 14th at 17.07%. That's a level not witnessed since late December 2021, just days before the S&P 500 hit its all-time record high on January 4th, 2022. So based upon this observed pattern over the past year, a sustained reversal back above 20% and certainly well above the 21-day moving average as well, that would suggest that a market top is very near at hand in the S&P. Let me just take a sip of coffee here. Going on and on, droning on and on. I'll try not to do that. We see the current setup in the S&P 500.
There was a question here, Jeff. Jeff, do you have time for a question?
Yeah, I do.
So somebody was asking about where all the capital is going to go, saying that this is Dennis McMahon. It's believed that treasuries are where the withdrawals are going to. Are you in agreement with that? Is everything going to treasuries or tips or things like that, or what?
That's what it looks like. It looks like short-term treasuries are absorbing a lot of this rotation out of banks, right? Apple might start to draw quite a bit as well from banks. But I think when if our scenario in the S&P 500 plays out, we think a lot more money is poised to rotate into T-bills. So this setup looks to be the most bearish since January of 2022. A lot of people believe that we're at the end of the bear market, that we put in a low in October and the bear market's over. The chart on the left-hand side is a 14-year monthly view of the S&P 500, looking back to the 2009 low to present. Based on this chart, I would say that the bear market in stocks hasn't even begun yet. We are in the very early innings of what we believe will be a super cycle counter trend corrective wave form in the S&P 500 that could carry the market down into the mid, say 1,000 to 1,500 range on the S&P. That sounds crazy to a lot of people. It sounds like hyperbole, right? But if we take a look at the chart on the right, which is a blown up version of that last 3 years, really off the COVID lows, okay? A low that we're calling cycle wave 4 of primary wave 4 of cycle wave 5 of super cycle wave 3. That's where we start. We count 5 waves up completed at 4 degrees of trend. And since the January 4th high, we count 5 waves down at primary degree, 3 waves up at primary degree, and then we see the market subdividing. Intermediate degree, wave 1 down, intermediate degree, wave 2 up, And then we think right now we've seen the March 24th low looks to us to be minor wave down, and the most recent advance looks like a complete counter trend advance, and we're calling it minor wave 2. So if we're correct about that, we're about to see a break to the downside of epic proportions. And so let me just blow this before, actually, the downside that we see here could carry in 5 waves down to a level that gets us kind of in the mid 2000s, 2750 to 2400, before completing primary wave 3 down. That's the next big plunge that we're anticipating. After that, we'll see what will be primary wave 4, which will be a lateral consolidation, and then a final plunge down to around 2250 on the S&P, which should complete cycle wave A of an ABC, which means it'll be followed by a counter trend advance that could retrace, say, 50% of the complete decline before wave C carries the market down to that 1,000 to 1,500 range that I mentioned. Now, again, this is work in progress. We're monitoring every single move that the market makes, and we've got some lower probability counts that we're also looking at as possibly being correct. In other words, the one on the left is our first alternate here. This suggests that rather than tracing out a complex or subdivided primary wave 3, we're still in primary wave 2, and it's basically just subdivided and turned into a double zigzag. And that means that we have slightly higher to go. We could trade back up to, say, as high as 4,300, which would retrace a total of 61.8% of the initial decline into the October lows. The second alternate count that we're looking at is the possibility that our first count's correct, but instead of being a motive wave, it's a corrective wave to the downside. So 3, A, B, C, instead of 1, 2, 3, 4, 5. The initial decline should still get us down into that sub 3,000 level before we get a big counter trend. But it suggests that what we've seen since, say, the June lows was actually a symmetrical triangle, and that the push above the upper boundary that we've experienced the last couple trading days is what's known as a throwover. And when we reverse back into the triangle's body itself, will suggest that we're in the heart of that C wave decline. So we don't know which one of these is correct. Our preferred count was the first one we showed you, and then we've got alternate 1 and alternate 2, and we'll kind of address them in that order. But whichever one is correct, the ultimate conclusion is the same. The next move is hard down. It's just a question of how far it carries. And so we'll know that in the course of time. On a short-term basis, this is what we're looking at here. If the preferred count's correct, then intermediate wave 2 up of primary wave 3 down topped on February 2nd. And that was at S&P 4195. So if we exceed that level today, then this count is invalid, and we'll move to our alternate count 1. But the decline that ended on March 13th actually counts best as minor wave 1 down of intermediate wave 3 of primary wave 3 down. So again, if 4195 holds, then this is the count we think is active right now. Now, the subsequent rally that unfolded in 3 waves, A, B, C, counts best as a zigzag corrective waveform. And once it's complete, it will mark the top of minor wave 2. We think that's probably complete or near complete. A break below the March 24th low will strongly support the idea that minor wave 3 down is in progress. And a break below the December 22nd low will confirm that. And it will confirm that a third of a third of a third wave decline, in other words, a third wave decline at 3 degrees of trend, an epic plunge, is in progress. Now, here's some other information, and it may or may not be germane, but Paul McCrae Montgomery, who was a terrific cycle analyst, had a Fibonacci time spiral that he organized across the lunar cycle, and it was very accurate in determining key turning points in the S&P 500. April 6th was a minor Montgomery cycle turn date, and April 20th, coming up here in a couple of days, is a major Montgomery cycle turn date. So we think that minor to major turn window could be suggesting that we're going to see this minor wave advance peak and a major downtrend begin in this window. The other thing that we would point out is that there's been a 50-day cycle that's very observable since we saw the lows in October. And that 50-day cycle is actually poised to bottom on or about May 24th. It could bottom a little earlier, May 22nd, which would be consistent with this, we've seen these dates come up, October 13th, December 13th, December 22nd, February 2nd, another 2-2, March 13th, April 13th plus 1, and we're thinking May 22nd, 24th, that window could be the next bottom for the plunge that we're looking for. So something to keep in mind. Now, the real question on most people's minds is this a cyclical or a secular bear market that we've been in? It's been our view that the market is in the very early innings of a secular bear market at super cycle degree of trend. And based upon our long-term analysis, using, looking at the market through the lens of the Elliott wave principle as our primary model, we believe that the 90-year advance that began in 1932 and ended in January of 2022 counts best as super cycle wave 3. And if super cycle wave 3 topped at S&P 4818, then super cycle wave 4, a corrective waveform at the same degree of trend, in other words, it's got to be proportional, is now in progress. And it could potentially retrace up to a Fibonacci 78.6% of the super cycle wave 3 advance before it's complete, and eventually potentially even test the lower boundary of the rising trend channel in the event of a severe global recession. So these are kind of the things that we're evaluating in real time right now. We do not know for certain if this is happening. It's a hypothesis, okay? So we're not making a forecast. We're simply saying that this is the setup in the market, and it's highly probable that this setup is poised to unfold. And if it does, this is the direction that it's likely to carry the market. So these are the numbers that we've got our eyes on. Now, everybody's been asking me, what's the catalyst for this, Jeff? I mean, a simple recession is not going to bring the S&P down to 1,000. Well, we've talked about this before. We've written about it ad nauseum for the past year. We think it's highly plausible that China and Russia are working together to undermine the West in order to achieve their own independent foreign policy objectives. We think that China supported Russia's invasion in the Ukraine in order to observe NATO's response. And since then, they've taken extraordinary steps to insulate themselves from any adverse repercussions should the same reaction befall them. China's also hoarding a 2-year supply of grain, and they've been building up their strategic petroleum reserves, potentially in advance of a planned military move on Taiwan, which would give them control of the world's semiconductor chip production. Now, everybody knows that over the Easter holiday weekend, following a meeting between Taiwanese President Tsai Ing-wen and U.S. House Majority Leader Kevin McCarthy, China engaged in a 3-day live fire military exercise that simulated a comprehensive naval and aerial blockade of the island of Taiwan. This exercise included the use of at least a dozen ships, nearly 100 aircraft, and based on what we read and some other sources that we have, put tens of thousands of Chinese troops on high alert. Now, if you're paying attention to what's going on in the news today, you'll know that this week the U.S. ran an operation in the South China Sea, basically freedom of navigation operation is what it's called. And they sent a U.S. military destroyer through what are arguably international waters, but China claims to be their waters, and it was successful. China has subsequently launched a naval military operation in the Sea of Japan and off the coast of North Korea right now. So the Yellow Sea, it's known as, between Japan and Korea. And so the US 7th Fleet has also been operating in the exact same body of water. There are now two naval task force of opposing sides, the Chinese and the Americans, operating within 100 miles of one another in the Yellow Sea. They are both live fire joint military operations, the US with Australia, Japan, and South Korea, and the Chinese now with Russia, who has now put their entire Pacific Fleet on high alert effective this morning. So if you want something to keep you interested in what's going on in the world and what could potentially be a catalyst for what I'm discussing here, I think there's nothing more clear in my mind's eye than the geopolitical risks that exist on the table right now, not just in Eastern Europe, but in the Pacific Ocean as well. So what's an investor to do? Well, I heard people talking about venture debt. I think my first slide pretty much puts the kibosh on venture debt. Venture debt, in my view, is probably the single riskiest asset class on the planet and the least likely to return your capital, okay? We think preservation of capital is now absolutely key. During a bear market, you just want to avoid losses and ride out the storm. So let's consider the options on the table here. The primary four core asset classes are property, stocks, treasuries, and commodities, okay? Now we can take treasuries, we could say it's the bond market per se, and equities could be global stocks, property could be global property, but let's focus on US asset classes for now. Right now, the US property valuations are at their highest levels of the past 40 years. We are currently trading around 3 standard deviations above their 40-year historic mean. US equities have basically come down from their highs, no question about it, which were about 2 standard deviations above, but they remain about 1 standard deviation above their historic 4-decade mean. Commodities are actually trading in line with their 40-year average valuation level today. But there is one option, and that's US Treasuries. US Treasuries are actually cheap versus their 40-year historical valuation mean. They're trading about 1 standard deviation below right now. And that doesn't mean that they can't get cheaper. It just means that in our view right now, short duration US Treasury securities could provide the best combination of value, safety, liquidity, and income over the next year. Again, if this is a bear market, you just want to avoid losses. You want to ride out the storm and collect your 5% or higher if rates keep going higher. I think that's the best way to position for the foreseeable future, but we'll call it the next year. With that, I just want to give myself one final commercial. Check out our newsletter on Substack. It's hugeinsights.substack.com. I think you'll find it worth your time.
Hey, Jeff, you can hear me, right? We have about 5 minutes. I wanted to ask you some questions.
Absolutely.
So I'm not a big believer in the geopolitical thing, but what do you think about de-dollarization? I mean, it seems like a couple of really big things happened in the last couple of weeks. One was that Argentina and Brazil announced that they're going to create a common currency to do trade, and that Saudi Arabia is going to be doing trade in yuan with China, and then there's this agreement between Iran and Saudi Arabia. So, any thoughts on that?
Yeah, lots of thoughts on that. I think number one, if the dollar is going to fail as the reserve currency of the world, give me one example of what currency you would rather put your money in. Are you going to put your money in the yuan, which is a closed economic system? Are you going to put your money in the euro? No way, okay? The United States of America is the global reserve currency because we have 11 aircraft carriers, okay? We have a maritime hegemony that guarantees free trade around the world, okay? The reason that the United States dollar is the reserve currency of the world is because we're the largest economy of the world, and everyone wants to do business with the United States, and you can't pay for US goods with anything but US dollars. Also, if we're buying your goods and if you want to export to the United States of America, we're not going to convert our currency to your currency. We're going to pay you in our currency, and the hell with you. If you don't want to accept our dollars, we're not going to accept your imports. It's as simple as that, okay? The reason the dollars come under pressure is because we put massive dollar-based sanctions on Russia and everybody who has anything to do with Russia. And that is it in a nutshell. Anybody who wants to come on and argue a different story than that, they're dreaming up a narrative, trying to get attention, trying to get headlines. None of it will come to pass, at least in my lifetime.
Yeah, I got a question here, Gudrun.
Yeah.
Say it to me and I'll repeat it.
In past panels, I've heard that gold, nickel, and copper should be bought now.
What about gold, nickel, and copper?
I don't know anything about nickel and copper. I mean, they're industrial metals, and if the economy tanks, they're going to tank. But I think gold is a reasonable speculation. And I think silver is as well. Silver might be the cheapest kind of mainstream asset on the planet. It's the only one that's not trading at its extreme highs, okay? And it's kind of like the little brother to gold. You know, wherever gold goes, silver eventually follows, right? Well, gold's trading at its all-time record highs right now, you know, a few dollars away. I think gold makes sense as a safe harbor if we do get into a kinetic war of some type with Russia, with China, with some adversary. I think there will be a flight to safety, and that flight to safety should include US Treasuries and gold. Gold is at fair value based on its 40-year historic mean, and I think it's a great store of value. We're recommending it within our research, and we're personally investing in it, and personally invested in it, and have been for some time.
Jeff, do you track crypto at all? I mean, any thoughts on Bitcoin?
We dropped coverage, so we no longer publish on it. But my thoughts on crypto is nothing. It's nothing. There is nothing behind it. There's nothing that supports it. It's an idea, and eventually, it's as good as you know, the people who agree with you. It's an opinion at this point, and I think ultimately, I think eventually it's going to 3,000. Okay. So I think it'll drop.
I have a funny story about crypto. I'll tell everybody at dinner time. I can't tell it here, but anyway, yeah, fantastic. And then somebody asked about the 14 agreement signed between China and Russia. Any thoughts on that?
Yeah, well, I think you're seeing it play out in the South Pacific right now.
Another question.
What about the the large risk of Israel and Iran? I'm hearing that there are preparations now in Israel for a strike. Was that mentioned? I came in.
Yeah, and I think I was reading. So somebody wrote an article. There's a great blog on China called Sinocism, right? And it talks about just looking at China, right? And it says that China doesn't really go to war. They surround you and they make it very painful for you not to become, you know, integrated into their, you know, country. But what about Israel and Iran? Because it seems like Iran has become allowed back into the mainstream of OPEC. Israel sees it as a threat. Any thoughts?
Yeah, I mean, I think Israel is going to do what Israel needs to do to you know, facilitate their future as a going concern, right? Whatever it takes, that's been it. Nobody knows exactly how far they're willing to go, but they've been they've demonstrated historically that they're willing to go to the mat whenever necessary. They make that decision. So it wouldn't surprise me. I think Israel will strike Iran if need be in order to preserve their future. And I hope it happens in May, because I leave for Israel on Thursday and I return on the 29th of April. So if World War III is going to break out, God, please let it happen on May 1st.
There you go. And so we have a couple of CRE guys here. Any thoughts on CRE? You know, because there's a lot of people talking about that the
I wrote 20 pages on it. I wrote 20 pages on it in my last newsletter. Sign up and you can read all about it.
Oh, come on, let something out of the kimono here. Come on, please help us out.
Sure,
Yeah.
I'll tell you this. I think it's a huge risk. 25% of office property mortgages need to be refinanced this year. We're talking about actually, we're talking about $470 billion. Okay, so almost $500 billion of CMBS will need to be refinanced. And, we're looking at national vacancy rates of 18.7%. That's an all-time record high. But that only tells part of the story. If you take a look at certain cities, and if you look at Class B office space, which much of this debt is on, these buildings have been empty for a long time. They're 50, 70% vacant at this point. So I think we got huge problems in the Class B sector and below. Class A could weather the storm. We'll see. Jamie Dimon thinks so, but anything on the lower end of Class A to Class B office could be devastated in the next 12 months. And I think retail is in the same situation. I don't think that they can repurpose all this retail space fast enough to save the retail sector.
And Jeff, I got to ask you, I mean, to me, short duration credit, that's where everybody fled to in 2008, 2009. So, I'm still a big proponent of it. But do you have any thoughts on that? And by short duration, I mean like 1 year lockup and then, pretty much monthly liquidity.
Well, how about, I got 2 words for you. Floating rate preferreds. What happened to floating rate preferreds in the great financial crisis? They got completely annihilated. Everybody who was in a floating rate preferred, which is basically short-term credit, the shortest credit, right? 7-day floaters, those went under. They completely liquidated that entire market. And basically, well, I worked at Citigroup at the time, and we had a product called MAT, which was municipal arbitrage, right? And it used those short-term floaters off of the all these levered municipal bond funds to put on an arbitrage trade. The product dropped 90%, lost 90% of its value. And Sally Krawcheck, who was the CFO at the time, said it wouldn't be right not to make this good, not to make good on these floaters, because she had just been promoted to CEO of Smith Barney from CFO of Citigroup at the time, if everybody recalls their history on this. And she stood up, and the firm made good on this, but the firm took a huge loss, which ended up on the bad bank side of the balance sheet. And Citigroup's still trading still trading on a reverse split basis at like $4. Okay, remember they did a 10-for-1 reverse split, so it was traded, with a double-digit handle, so institutions could buy the stock. But if you went back and took a look, the stock went from $58 to 7 cents. Okay, that was the decline in Citigroup stock from I think January of 2008 to March of 2009.